Ladies and gentlemen, the money supply in the United States contracted by 4.7% from April 2022 to October 2023. That was the first sustained decline since 1933. The first time in 90 years that the total amount of dollars circulating in the American economy actually shrank. And if you think that's just some abstract economic statistic that doesn't affect your grocery bill, your rent, or the value of every dollar sitting in your bank account, I need you to listen very carefully to what I'm about to tell you, because that contraction has already reversed. As of January 17, 2026, M2 money supply stands at $21.74 trillion, up from $21.03 trillion at the October 2023 trough. The Federal Reserve just added $710 billion back into the system in 15 months. And what almost nobody is talking about is what that monetary whipsaw means for your purchasing power over the next 2 to 3 years. My name is Ryan, and I've spent the better part of a decade tracking Federal Reserve policy, money supply data, and the mechanisms through which your dollars lose value while you sleep. I obsess over this so you don't have to wade through hundreds of pages of Fed reports and economic data. If understanding how monetary policy directly impacts your wealth matters to you, make sure to hit that subscribe button and give this video a thumbs up if it helps you see the financial system more clearly. Because what I'm about to show you is the hidden inflation mechanism that happens regardless of what the Consumer Price Index reports. The M2 money supply is the broadest measure of dollars available for immediate spending in the economy. And when it grows faster than economic output, that gap becomes inflation by definition. Too many dollars chasing relatively fewer goods. The math is simple, but the implications are massive. Here's what most people don't understand about money supply. M2 isn't just cash. It includes currency in circulation, yes, but also checking deposits, savings accounts, and money market funds. Essentially, every dollar you could spend today without selling an asset. From February 2020 to April 2022, M2 exploded from $15.48 trillion to $21.72 trillion. That's a $6.24 trillion increase in 26 months. 40.3% growth, the fastest monetary expansion in United States history. Pandemic stimulus checks, Federal Reserve asset purchases totaling $4.6 trillion, banks creating credit at unprecedented rates. The printing presses, digital and otherwise, ran at full speed. And then something remarkable happened. The Federal Reserve, facing inflation that hit 9.1% in June 2022, began quantitative tightening. They started reducing their balance sheet, pulling liquidity out of the system. By April 2022, they'd begun the most aggressive rate hiking cycle since the early 1980s, pushing the federal funds rate from near zero to 5.5% by July 2023. And for the first time since the Great Depression, M2 contracted. It shrank by 4.7% over 18 months, $1.3 trillion removed from the money supply through quantitative tightening and reduced bank lending. Financial media treated this as a non-event, a technical detail. But here's what they're not telling you about that. Monetary contractions of this magnitude have historically preceded or accompanied severe economic recessions. The 1931 to 1933 contraction saw M2 fall 31%, and that collapse in the money supply turned a recession into the Great Depression. It destroyed banks, evaporated savings, and created deflation so severe that debts became impossible to service. The Federal Reserve learned from that disaster that monetary contraction is economically catastrophic, which is exactly why the 2022 to 2023 contraction was so unusual and why it reversed so quickly. Now, before you think this means the Fed successfully engineered a soft landing and everything's fine, let me show you why that's exactly backwards. The contraction stopped not because inflation was defeated, but because the fiscal and political costs of continued tightening became unbearable. In June 2024, the Federal Reserve paused quantitative tightening. They stopped reducing their balance sheet, holding it steady at $7.18 trillion rather than continuing the planned reductions. And by November 2024, something shifted. M2 resumed growth. 2.8% annual growth through January 2026. $710 billion added back to the money supply in just over a year. That's not the Fed hitting the brakes anymore. That's the Fed tapping the accelerator again, just more gently than during the pandemic. And the reason this matters is what's driving that renewed growth and what it means for your dollars over the next several years. What I'm about to show you next is the mechanism that almost nobody connects to their daily financial lives, but it's the thing that determines whether you're getting richer or poorer regardless of your salary. The driver behind M2 growth resuming isn't mysterious. It's federal deficit spending on a scale that makes monetary restraint mathematically impossible. The federal deficit reached $1.83 trillion in fiscal 2024, $1.97 trillion in fiscal 2025, according to Congressional Budget Office data from January 2026. The Treasury has to issue massive amounts of new debt to finance that spending. And here's where it gets interesting. When banks expand credit to purchase Treasury securities, or when the Federal Reserve directly or indirectly finances that debt through reserve creation, M2 increases. You don't need explicit quantitative easing for the money supply to grow. You just need deficit spending financed through the banking system. And with national debt now at $36 trillion and annual interest costs hitting $1.163 trillion, 23% of all tax revenue goes just to service the debt, not to pay it down, just to cover the interest. The trap is complete. Here's the calculation that should terrify anyone holding cash as a significant portion of their wealth. If M2 grows 2.8% annually while real economic output, actual GDP growth, increases only 1.9%, that 0.9 percentage point difference represents pure monetary inflation. The money supply is expanding faster than the production of goods and services, which means, by definition, each dollar must become worth less, not in some abstract theoretical sense, in actual purchasing power. The dollars in your savings account, your checking account, your money market fund, they're all losing value at roughly 1% per year just from this gap. And that's before we account for the lagged effects of the previous 40.3% expansion that hasn't fully worked through the price system yet. Monetary expansion operates with 18 to 36-month lags before it fully appears in consumer prices. The money created in 2020 and 2021 is still rippling through the economy, still bidding up prices in sectors where it hasn't fully hit yet. Let me paint you the timeline of purchasing power destruction that connects all this monetary data to your actual household budget. From January 2020 to January 2026, M2 increased 40.5%. From $15.48 trillion to $21.74 trillion, according to Federal Reserve H.6 data. Over that same 6-year period, the official Consumer Price Index increased 21.3% based on Bureau of Labor Statistics calculations through January 2026. So even by the government's own inflation statistics, your dollars lost 21.3% of their purchasing power. But here's where the math gets darker. If M2 increased 40.5% while real economic output, real GDP, grew only 13.7% from 2020 through 2025, the implication is that each dollar should theoretically be worth about 23.7% less. The gap between money supply growth and economic output growth suggests actual purchasing power loss exceeds what CPI measurements show. CPI has methodological issues we could spend an hour discussing, but the core point is this. When you create 40% more dollars but only 13.7% more goods and services, the excess money has to go somewhere. And it went into asset prices and consumer inflation. That $6.26 trillion increase in M2 since January 2020 didn't just disappear into the ether. It became the inflation you felt at the grocery store, the gas pump, in your rent payments. It became the surge in housing prices, stock market valuations, and commodity costs. And here's the wealth transfer mechanism almost nobody talks about. If you held cash or fixed income assets like bonds paying 2% while inflation ran 7 to 9%, you lost purchasing power, a lot of it. But if you held real estate, stocks, commodities, or even quality collectibles, you likely came out ahead, because that excess money supply bid up asset prices. The people who understood this, who positioned themselves in assets rather than cash, effectively transferred wealth from savers to asset holders. From people on fixed incomes to people who owned property and equities, the monetary expansion didn't just cause inflation. It quietly redistributed wealth on a massive scale, and most Americans never understood the mechanism that did it to them. If you've made it this far, you're already ahead of 90% of people who think inflation is just companies being greedy or supply chain problems. But don't stop now, because what comes next is the part that determines whether you'll be prepared for the next wave of monetary expansion or caught off guard like last time. Now let me show you why the M2 contraction of 2022 to 2023 was always going to be temporary, and why that matters for your financial future. The United States has painted itself into a fiscal corner that makes sustained monetary contraction politically and economically impossible. With 36 trillion in national debt, every percentage point increase in interest rates adds hundreds of billions to annual debt service costs. When the Fed raised rates from near 0 to 5.5%, interest expenses on the national debt exploded. They went from roughly 300 billion annually in 2020 to 1.163 trillion by 2025. That's an $863 billion increase in just 5 years. And here's the trap. If the Federal Reserve had continued quantitative tightening, if they'd kept shrinking the money supply and keeping interest rates elevated, debt service costs would have continued climbing until they consumed an unsustainable portion of the federal budget. You'd eventually face a choice. Default on the debt, implement severe austerity to free up revenue for interest payments, or reverse course and resume monetary expansion to keep the system functioning. They chose door number 3. Because default is politically unthinkable and austerity is political suicide, which means monetary expansion is the path of least resistance. It's the soft option that delays the crisis and spreads the pain across all dollar holders through inflation, rather than concentrating it in government spending cuts or tax increases. This creates what I call the one-way ratchet. The money supply can expand rapidly during crises, emergencies, or periods of fiscal stress, but it cannot contract meaningfully for extended periods without triggering a fiscal and economic catastrophe that forces reversal. Look at the historical pattern. M2 grew 10.8% annually from 1959 to 2019, according to Federal Reserve historical data. That means the money supply doubled roughly every 6.6 years for 6 decades. Consistent, relentless expansion that guaranteed long-term purchasing power erosion regardless of short-term consumer price index fluctuations. Some years inflation ran hot, some years it was subdued, but the underlying monetary expansion never stopped for long. The 2022 to 2023 contraction was an anomaly. 18 months of tightening driven by inflation so severe the Fed had no choice but to act aggressively. And even that historic tightening, the most aggressive since the Volcker era of the early 1980s, lasted less than a year and a half before reversing. Before the political and fiscal pressure forced them to stop shrinking the balance sheet and allow M2 to resume growth. What this tells you is that monetary expansion is the permanent default state of the modern financial system. Dollar debasement isn't a bug, it's a feature. It's how governments finance deficits without explicit taxation. It's how they reduce the real value of debt over time. And it's why holding significant wealth in cash, or cash equivalents over multi-year timeframes, is a guaranteed wealth destruction strategy. Your dollars are melting ice cubes. The only question is how fast they're melting in any given period. Let me give you the framework for actually protecting your purchasing power in this system, because complaining about monetary policy doesn't pay your bills or secure your retirement. First, track the M2 growth rate relative to real GDP growth. This data is publicly available from the Federal Reserve and Bureau of Economic Analysis. When M2 growth exceeds real GDP growth by more than 1.5 percentage points annually, excess monetary inflation is occurring regardless of what the Consumer Price Index reports. That gap is your signal that dollars are being debased faster than the economy is producing real value. It's your early warning system that inflation pressure is building even if it hasn't fully appeared in consumer prices yet. Because remember, there's an 18 to 36 month lag between money creation and its full effect on prices. M2 data is a leading indicator. CPI is a lagging indicator. If you wait for CPI to tell you inflation is here, you're already behind. Second, understand money velocity and what it means for future inflation. The velocity of M2, how frequently each dollar circulates through the economy, is currently depressed at 1.35 according to Federal Reserve data from Q3 2025. The historical average is around 1.85. When velocity was higher, each dollar changed hands more frequently, generating more economic activity and more upward pressure on prices. Velocity collapsed during the pandemic as people hoarded cash and economic activity slowed. But as velocity normalizes and rises back toward historical averages, the existing money supply will generate significantly more inflation without a single new dollar being created. Think about what that means. You could have zero M2 growth And if velocity increased from 1.35 to 1.85, that 37% increase in how fast money circulates would create substantial inflation pressure all by itself. Now combine rising velocity with the 2.8% annual M2 growth we're currently experiencing, and you can see the inflationary potential building for 2026 and 2027. Third, recognize that the fiscal situation makes future monetary restraint increasingly difficult. Every year that deficits run near $2 trillion, every year that debt service costs consume a larger share of tax revenue, the Federal Reserve's ability to fight inflation through monetary tightening diminishes. Because tightening raises interest rates, which increases debt service costs, which worsens the deficit, which requires more borrowing, which puts upward pressure on rates, which makes tightening even more painful. It's a vicious cycle that eventually forces the central bank to choose between price stability and fiscal stability. And history shows central banks always choose fiscal stability when truly forced. They'll tolerate higher inflation before they'll tolerate government debt crisis, which means the bias is always toward looser monetary policy, higher M2 growth, and ongoing currency debasement. Now we get to the part that actually matters for your financial decisions, the psychological shift you need to make. Most people are taught to think of cash as safe and assets as risky. That framing is exactly backwards in an environment of persistent monetary expansion. Cash is guaranteed purchasing power loss. That's not risk, that's certainty. You are guaranteed to lose 1 to 3% of purchasing power annually, minimum, by holding dollars. Assets have volatility, yes. Prices go up and down. But quality assets, things with real utility or scarcity, tend to appreciate in nominal terms over time, precisely because the monetary base keeps expanding. Real estate in desirable areas, productive businesses, scarce commodities, even certain collectibles with genuine demand, these things get bid up as the money supply grows because there's more dollars chasing the same or slower growing supply of real assets. The mental shift is understanding that what feels safe, a savings account with FDIC insurance showing a stable number, is actually the riskiest long-term position because that stable number represents declining real value. And what feels risky, owning assets that fluctuate in price, is actually the safer long-term position because those assets have a chance to keep pace with or exceed monetary expansion. I'm not telling you to gamble on speculative assets or take stupid risks. I'm telling you that the definition of risk itself changes in a system with persistent currency debasement. The biggest risk becomes staying in cash too long, letting inflation erode your wealth silently while you think you're being prudent and conservative. Here's the hard truth that might sting a little. The system is designed to punish savers and reward debtors and asset owners. That's not a moral judgment, it's a description of how monetary expansion works. If you borrow money at 4% to buy an asset that appreciates at 6% nominally while inflation runs 3%, you win on 3 levels. The asset appreciated faster than your borrowing cost. Inflation reduced the real value of your debt, and you avoided holding cash that lost 3% purchasing power. Meanwhile, the person who saved diligently in a savings account earning 1% while inflation ran 3% lost 2% real purchasing power annually. Their virtue, their prudence, was punished by the system. This isn't fair. But it's how the game is structured when you have persistent monetary expansion and artificially suppressed interest rates. Almost there. But before I wrap up, I need to show you how all of this works together and why the M2 contraction and reversal isn't just an interesting economic factoid, but a window into the machinery of wealth transfer happening all around you. The M2 contraction of 2022 to 2023 was remarkable, not because it was deep, 4.7% is nothing compared to the 31% contraction of the Great Depression, but because it happened at all in the modern era, and because it revealed the limits of monetary discipline in a heavily indebted system. The Federal Reserve tried to engineer a traditional inflation fight. Raise rates, reduce the balance sheet, let the money supply contract, cool the economy, bring prices down. For 18 months, it actually worked in terms of slowing M2 growth and eventually contracting it, but the fiscal cost became unbearable. Interest on the debt exploded. Economic stress mounted. And the political will to continue tightening evaporated. So they stopped. They paused balance sheet reduction and allowed monetary conditions to ease again, and M2 resumed growing. What this teaches you is that the Federal Reserve is not truly independent when fiscal conditions deteriorate enough. They're constrained by the reality that the federal government cannot function if borrowing costs stay elevated indefinitely. The central bank's inflation-fighting credibility is real, but it's subordinate to keeping the government solvent, and that means over long time frames, the bias is always toward expansion, always toward inflation, always toward slow but steady debasement of the currency. The dollar lost roughly 96% of its purchasing power from 1913, when the Federal Reserve was created, to today. That's not a failure of policy. That's the policy working as intended. Slow, manageable inflation that reduces the real burden of debt and allows continuous deficit spending without immediate crisis. For you, the individual trying to build and preserve wealth, this means several things. First, understand that M2 growth trends reveal debasement rates years before they fully appear in consumer price inflation. The 40.3% expansion from 2020 to 2022 told you in real time that massive inflation was coming, even when official CPI was still subdued in mid-2021. If you'd tracked M2 and understood the implications, you could have positioned yourself in assets before the inflation surge fully hit. You could have locked in low mortgage rates, bought real estate, allocated to commodities, anything except holding cash. Second, recognize that M2 contraction is so rare, only twice in 90 years, that when it happens it signals extreme monetary stress and will almost certainly reverse quickly. Don't mistake temporary tightening for a permanent shift in monetary regime. The structural incentives all point toward expansion. Third, build a personal inflation defense system based on hard assets, productive investments, and minimal cash holdings beyond emergency reserves. The specific assets depend on your situation, knowledge, and risk tolerance. But the principle is universal. You cannot win by holding dollars over multi-year periods when M2 consistently grows faster than GDP. The math doesn't work. Your cash loses. Finally, understand that this isn't about predicting the future or timing markets perfectly. It's about understanding the rules of the game you're playing. The game is monetary expansion, fiscal dominance, and persistent currency debasement. The winners are those who own real assets. The losers are those who work hard, save diligently, and keep their wealth in cash, watching it evaporate slowly through a mechanism they never learned exists. The $21.74 trillion in M2 today versus $15.48 trillion in January 2020 isn't just a number. It's a 40.5% expansion of the monetary base in 6 years. And that expansion didn't make America 40% wealthier. It redistributed existing wealth from people who held dollars to people who held assets. It's the largest wealth transfer mechanism in the modern economy, and it operates in plain sight while most people never notice. They just wonder why everything costs more, why their paycheck doesn't stretch as far, why retirement seems further away despite years of saving. The answer is in the money supply data they never look at. So here's what you do. Go pull up the Federal Reserve H.6 report. Look at M2 historical data. Track the growth rate, compare it to real GDP growth, calculate the gap. That gap is your dollar debasement rate. And then ask yourself, is my wealth positioned to survive that debasement? Or am I the person holding the melting ice cube while telling myself I'm being financially responsible? Because the people who built real wealth over the past decade weren't the ones with the biggest savings accounts earning 0.5% interest. They were the ones who understood that in a world of persistent monetary expansion, cash is trash and assets are armor. They were the ones who borrowed cheap money to buy real things, who allocated to scarcity, who understood the game. 10 years from now, you'll look back at this moment, at M2 sitting at $21.74 trillion and climbing, at deficits near $2 trillion annually, at debt service costs consuming almost a quarter of tax revenue, and you'll know exactly what happened next. The money supply kept growing because it has to. Inflation stayed elevated or returned in waves because that's what happens when money grows faster than output. And the people who positioned themselves accordingly built wealth while those who didn't fell further behind. The question is which group you'll be in. The data is public, the mechanism is clear, the choice is yours. What financial topics should I break down next? Inflation, interest rates, federal debt, the mechanics of quantitative easing, whatever's affecting your financial life that you're not getting straight answers on, drop it in the comments. That's what this channel exists for. Your future wealthier self is counting on you to understand how the system actually works, not how you wish it worked. And it starts with recognizing that the money in your pocket is worth less today than yesterday, and it'll be worth even less tomorrow, because that's exactly how it was designed to function.